Welcome to Business Unmuted, and thanks to our sponsor Vertu Motors, one of the UK's largest motor retailers, representing some of the world's best manufacturers of cars, vans and motorcycles. Check out its website on virtumotors.com. I'm Graham Robb. I've owned my firm, Recognition PR, for 35 years. We've got 75 clients in lots of sectors across the UK. They have a turnover of 6 billion and employ around 30,000 people. So we're at the front line of the business community and perfectly placed to discuss the economic climate, which we're going to do today. In the studio we've got Martin Anderson, CEO of Lemon Contact Centres, multi-platform contact centres based in the northeast in Stockton, and he has clients in lots of different sectors across the UK, answering their phones and servicing their needs. Down the line we're joined by independent economist Julian Jessup, who has more than 3 decades of experience dealing with economic data. He's a regular on TV and radio, one of the UK's most respected economists. And we're also joined by Andy Crawford, Director of Business Moves Group, which is supporting several big name brands with workplace moves. Gents, welcome to our programme today. Julian, let's start with you. We've had a lot of economic commentary in the news. It's right up there in the headlines, the starting point being the IMF report saying that the UK economy is a basket case. It's going to be shrinking compared to our peer group economies. Do you buy it?
Well, no, I don't. I don't think the IMF has a great track record in forecasting. A lot of the assumptions on which it seems to be basing its numbers are already looking out of date. You know, the outlook for interest rates and energy prices in particular. And the final point is that I don't think its forecasts really add up anyway. It's become more pessimistic about the UK, while at the same time being more optimistic about almost everywhere else. So there seems to be a bit of a disconnect there. I wonder if the team doing the UK numbers aren't talking to the others. I suspect that we will be obviously facing a very difficult period this year, but no worse than many other economies, particularly the likes of Germany, that is teetering on the brink of recession. And actually some of the recent economic data from the US has been pretty appalling as well. So I don't think we'll have a great year, but I don't see any great reason to think we're going to be doing a lot worse than some of our peers.
I suppose because this week was the 3rd anniversary of actually leaving the EU, Brexit Day, 31st of January, there was a lot of Brexit blaming going around in the national commentariat. I don't think you're one of the people who blames Brexit, but can you understand why people would be concerned that Brexit destroyed our ability to trade with Europe on very straightforward, paperless grounds?
Yeah, no, I think there are reasons to be worried here. I mean, I'm a Brexit supporter. I'm an optimist about what the longer term benefits might be. But even I recognise that in the short term, the economic impact has been negative. And obviously, the main thing that we've done is increase barriers to trade with our biggest single trading partner. We've made it more difficult to attract labour from the rest of the European continent. We damaged business investment, and we probably deterred a lot of people from buying UK assets. So I think the initial impact has undoubtedly been negative. But where I disagree with the consensus is how big a negative it has been. And just as importantly, maybe more importantly, how long this negative impact is going to last. I think a lot of it is to do with uncertainty, the amount of time it takes businesses to adjust. And there's still some big aspects of Brexit haven't been done yet. So fixing the Northern Ireland Protocol. So hopefully it's darkest before the dawn, and from now on, the news on Brexit will start to improve.
I've just a view from the north where I am. I actually was one of those people in business. I was chairman of the IOD in the northeast at the time of the Brexit vote, and I was a Remainer as a result of that. But I'm one of the few people who's come round to some of this stuff. We've got a free port in Teesside, which is attracting a lot of interest. I'm on the board of the Development Corporation there for full disclosure. And also our big project in the energy sector is the offshore wind project. And the government took an unusual position to defend sovereign capacity by requiring the big developers of offshore wind to have 60% produced of the capital and of the servicing of the wind farms be British based. Now that would be illegal under EU rules to be so prescriptive. So there are some tangible benefits that in the Teesside area we're starting to see. Maybe they're difficult to see if you're taking a more realistic view of the UK economy.
Well, we're starting to see benefits in other areas as well. So if you look at regulation, for example. Deregulation was a big theme of Brexit, and we're starting to see some good progress there in areas like financial services and other sort of big cutting edge areas like biotechnology, where we could probably regulate things a lot better than the European Union does. And then other areas as well, things like now we're outside the common agricultural policy, we can have a sensible regime of farming subsidies that, actually better for consumers, but also better for the environment. So some of the benefits on the regulation side are starting to come through. And we're finally starting to do our own, new free trade deals with countries like Australia and New Zealand. Now, obviously, they're pretty small in the bigger scheme of things, but I think that's only just the start. And we will be able, in due course, to have better trade deals with the US, with faster growing emerging economies like China and India. So there's plenty of potential there. My one concern there is whether this government or any future government is really willing to take some of the political flack that might be generated by lowering barriers to trade and reverting to a more sort of open economy than we've had for many years.
Okay, well, we could go down the Brexit debate for a long time, so I'll move back onto the economy in general. The inflation rate tweaked down in the latest data, but it's still too high. And tomorrow, that is Thursday for people watching this over the weekend, the Bank of England will be setting rates again. I'd be interested in your point of view, but just to report back, the North East has a shadow MPC made up of businesses and run by an accountancy firm and my own PR firm. And the shadow MPC, in conjunction with the Northern Echo, came to the conclusion by only one vote that rates should go up. And they said if they go up half a point, 0.5% rather, 50 basis points, and conditionally pause them, which I understand the Bank of Canada did. Now, that's what people on the ground in the Northeast thought, marginally by one vote. What's your view? If you were on the real MPC, what would you say?
Well, for what it's worth, my vote would be for one final half-point increase, taking interest rates to 4%, but then pausing. Indeed, it wouldn't surprise me if the next move in interest rates after that is down. Now, the key point here, of course, is what happens to inflation. But I think there are three big reasons to expect inflation to fall quite sharply this year without the need for further rate increases. One is the economy, of course, itself is weakening. So the sort of demand pull pressures on inflation not as strong as they used to be. The second is on the cost side. So things like global commodity prices have peaked, energy prices, wholesale prices at least are falling quite sharply, and a lot of the supply side disruptions are fading. And then the third point, which might sound a bit geeky, but I think is arguably the most important of the three, is that the monetary drivers of inflation are changing. So, I take the view that inflation is ultimately caused by too much money chasing too few goods and services. But one thing that's happened recently is that the growth of the amount of money in the economy has fallen very, very sharply. So there's less money around than there was before. And that should mean that inflation drops off pretty sharply in the next year or two.
Well, that's a positive outlook from you. And if interest rates do get a rise, as you suggest tomorrow, you talked about pausing, but should the bank send a forward signal? I was talking to someone who is involved in the Bank of England a few weeks ago, and they were saying that they got into a lot of trouble with what they described as forward guidance a couple of months before, in the last year with Mark Carney before he left. Should it try forward guidance again with this conditional pause?
Yeah, I think there's a danger of being too explicit. I think if I remember right, what Mark Carney said was that we would change interest rate policy if unemployment hit a certain level. And in the event, people were surprised about how quickly unemployment moved. And so they then had to sort of rethink what their guidance is. I think often this is a case of, less is better. I think it's better to say less about the exact conditions on which you would change interest rates again. I think the important thing is to signal that you are pausing for a period. And I think that would be really reassuring. In particular, I think it would mean that, some of the pressure would come off mortgage rates. So when people talk about the Bank of England raising rates and that being bad for the mortgage market, what really matters is not where interest rates are now or even where they are at the end of this week, but where they're expected to go. So if the Bank of England can signal that interest rates have peaked, at least for now, then mortgage rates could actually fall because they depend on where people think interest rates are going to be in 2 or 5 years' time. So I think that that could be quite a powerful thing to do.
It's a
So on one
fascinating
hand,
thing. And of course, these rates have to catch up. And if the bank keeps pushing it up and up and up, they don't get a chance to catch up, do they? Because so many are on fixed rates. I remember when I bought my first house, an interest rate change would be reflected immediately in the mortgage
well,
rate.
that's a very good point, because that means a lot of the interest rate increases we've had already from the Bank of England haven't actually impacted the economy, because people are still paying their old fixed rates. So there is a danger that if the bank continued raising interest rates, beyond this week, then it's like pulling a brick with a rubber band. Nothing will happen for a while, then suddenly the brick will whack you in the face. So I think there's a good case for pausing now, just to see what the full impact of the past increases are going to be on the mortgage market and the housing market more generally.
Very good point. And the last point, I've dominated you because you are a great speaker on these matters, and I wanted to hear a lot what you had to say. But the last thing, you mentioned unemployment in that last answer about interest rates. The Yorkshire Post was running a report from the Centre for Cities where there was a challenge on what the true jobless rate is. Is it 4%, 4.5%, or is it really up there at 10 to 15% when you take into account people who are not working but could work?
Yeah, I think that some of the headlines here are a bit misleading. They're talking about what the true level of unemployment is, but the point is you can define unemployment in different ways. So I personally think that the true numbers are the lower numbers. So if somebody is not looking for work, then I personally don't regard them as unemployed. But there is a bigger problem in the background, that there are probably too many people who are what are described perhaps unfairly as economically inactive. So they are not in work and not looking for work, but potentially they could be tempted back into employment. And there's a particular issue amongst the over 50s who, for one reason or another, have dropped out of work over the last few years and don't necessarily want to come back again anytime soon. If we could encourage those hundreds of thousands of people, as they are, back into work, that could provide quite a big boost to growth. But to describe them as unemployed because of choices they freely made, I don't think is an accurate description of what's going on.
All right, Julian, hold on there. We're going to talk to our other guests for a few minutes. We'll come back to you to wrap at the end. First of all, let's bring Andy Crawford in from Business Moves Group. Now, you move businesses. You literally move them like removal company, but it's a lot more complex, isn't it?
Yeah, absolutely. Yeah, a lot more complex than that. I mean, we've got the issue with remote workers at the moment, and businesses trying to get these remote workers back into the office. Energy costs are an issue. Obviously, if you're working at home, you're using approximately 75% more gas over the winter periods and 25% more electricity. Now, that's not caused a mass rush back into the office environment for the majority of our clients. Still looking at numbers of 25 to 30% of occupation levels in all of their buildings. Rising energy bills may eventually be the catalyst that sparks a return to the office, but it's very superficial to tell employees to come back to the office so that you don't have to pay for heating. Work-life balance is something that a remote worker is far more important to a remote worker than paying for additional heating costs. So we have the complications of all of that, as well as everything else that we're dealing with in the economy regards office moving.
So all these factors are presumably feeding into you being quite busy moving offices around.
Yeah, absolutely. Our clients are looking at an office experience to have the carrot of inviting or getting our employees back to the office. They've got to have an experience, and the pandemic's taught us that we can work from home effectively and efficiently. Common theme moving forward for businesses that we're dealing with, no matter what industry it is to create an environment that's agile, responsive to their team's needs, but simultaneously creates a belonging in the organisation. Having a brilliant, great workspace has its benefits, but only if it's truly serving the needs of the employees who are working in it.
Now, Andy, before I move to our next guest, you've heard what Julian had to say, very respected economist, giving us a snapshot of how he saw the economy. What are your big challenges in business at the moment in respect of some of the points that Julian was making?
Yeah, well, businesses are taking their time to try and recover from the pandemic. The economy suggests that people and leaders in our client businesses are still unsure on how they move forward. So spending money to reimagine their workplace and have a strategy to refine the workplace experience costs money. And we're looking at, they're talking about financially being really real issues and moving forward with that. That's one of the reasons why businesses are slow in making those changes.
And what about your own business? You heard Julian talking with me about unemployment and the fact that there are quite a lot of people who are not in the workplace who could, if they chose to be in the workplace. Are you having staff recruitment issues as many businesses are?
We are, maybe not to the certain extent of other businesses. We have as a business itself, we're quite long-standing. We've got a lot of, we don't have a lot of high turnover of staff. We have a lot of staff who have been with us for a number of years. So I don't think we have suffered a great deal in consideration with other industries. We were quite active during the pandemic. We worked with a lot of the private sector organisations as well as the public sector who were really active during that. So we didn't lose a lot of staff during the pandemic, which allowed us to bounce out of it and still have that real good solid skill set to allow us to carry on operating.
Martin Anderson from Lemon Contact Centres. You run these call centres, very impressive operation, very slick, lots of technology. But what about the people element? The turnover, is it stable, high? Do you want more people?
Yeah, I mean, it's been a challenge post-pandemic in recruitment, no doubt. It is getting easier. I would say there have been slightly harder times in the last sort of 6 months, a year to actually recruit, so that the pressure's slightly off, but it is still hard, and there's a big gap in the economy, the lack of resource out there. We talked about the hidden unemployment, the over 50s, etc. How to use technology to circumnavigate that to increase productivity. So that challenge isn't going away, but for businesses like mine, it creates an opportunity, because one of the things we do is support other businesses with different projects, providing them resource to fulfill those outbound or inbound campaigns where they may be struggling themselves to recruit directly.
That's absolutely. Where there's a problem, there's always an opportunity.
Indeed.
Now, Martin, when it comes to other elements of the economy, you heard Julian talking about inflation, for instance. Are you finding inflationary pressures in your business? I see it in mine quite often on wages and staff wages.
And that's probably the biggest thing. I mean, obviously we have the gas or the electric costs in our regard, which are a pressure. But the biggest thing, to some extent, is the pressure on wages. The increases that are coming through in April in the national living wage, which is a big increase. And it's not just about that entry level wage into the business, because being a contact centre, we do have people enter on that wage, but it's everyone else has stepped above it, so it causes an increase in wages across the board. Otherwise you're getting a narrowing depending on the different skill sets, so the pressure goes right through. So as a business, the biggest increase, our biggest bill is our wage bill, and the biggest increase we're going to see is our wages, which then goes back to the things that Julian was saying at the beginning. It can actually then feed back into inflation, which makes life difficult. I know Julian mentioned about there's a drawdown in the amount of money in the economy, which is absolutely correct. But it's interesting to note as well, I suppose a lot of the economy is not driven per se by money, but by credit available. So as we're seeing that reduction in credit, I guess that will also impact on the inflation rates.
On the wage conversation, at the moment there's a lot of public airing of the public sector wage disputes that are going on, and you're seeing the salaries of teachers, the salaries of nurses published, and you're seeing a claim by the public sector unions that their pay rises are less than the private sector pay rises. Probably true, not disputing those figures. But I had a conversation with one of my people the other day who was commenting on the pension contributions that some of the public sector receive. Now, I, in the private sector, as a small business, make the legal required pension contribution, but compared to, I think it's 23% for pension for teachers and a considerable amount for nurses, those packages are considerably more generous on pensions.
Yeah, no, they are. They're absolutely phenomenal, and the teachers one in particular. But it is hard as being an employer, like you said, with the pressures on the inflation and on wanting to give your staff a good wage and an increase that tries to keep up with inflation, but when you see what's going on right now with the strikes and some of the wage demands, I mean, some of the demands, 10, 15, 20% of things that you're seeing, to me it's like a whole different world. How as a business can we, as a private business, increase our wages by that amount without having a massive impact on our price of our product, which is going to impact our clients as well. It's making, with my industry as well, it's a global world now, so we're competing with Eastern Europe, we're competing with South Africa. I can go into a presentation, I'm putting my price out there, but the South African market is able to come in at a price which is less than our minimum wage.
Yeah, and his call centres are English speaking.
There's no time difference, particularly an hour or so. We're moving south. It makes competing in a more globalised market, particularly in the retail sector, almost impossible.
Very interesting. Julian, let's pick up with you. Let's give you the last word on this. This differential between, you see the news clips where the public sector unions are saying, well, we've got average wage increases of 3%, the private sector 7%. That is apples and pears when you put the pensions in, isn't it?
That's right. I think it's important to distinguish between rates of change, what the size of the pay increases are, and the starting point. So it's certainly true that public sector wages have gone up by a lot less than those in the private sector for most of the last 10 years or so. But the level of pay in the public sector is still relatively high. And it's even higher if you factor in not just things like pension contributions, but if you allow also for things that are harder to put numbers on, like job security. So job security is typically a lot higher in the public sector than it is in the private sector. So I think in general it's pretty hard to say that the public sector workers as a group are systematically underpaid. I think if I were advising the government, I'd try and say, well, look at this like you would if you were a private sector employer. So if there are particular areas where you have problems of recruitment and retention, so certain types of nurses with certain qualifications, or teachers of particular subjects like mathematics, then maybe give them a bigger pay increase. But I think the argument for a big inflation busting pay increase across the board in the public sector is actually remarkably weak.
Well, look, I'm going to leave it there. We've had a good airing. Andy, thank you for joining us. Martin, thank you. Julian, as ever, a very good explanation of where you see the economy. Thank you for joining us on this edition of Business Unmuted. We'll be back at the same time, same place next week.